Consider what happened a year ago. Everyone expected a strong economic recovery and summer of love in 2021 thanks to COVID-19 vaccinations. Some even claimed that the pandemic's conclusion was near. Then came the Delta and Omicron variants. As 2021 came to a close, the epidemic continued unabated, sending out a slew of confusing signals and hampering the global economic recovery. What are the best investments for investors to make this year with bond and CD yields so low, some assets at astronomical values, and the economy still recovering? Let's find out. But first, hello and welcome back to the channel. This is Financial and Investment Wisdom, and we're back with another incredible video. Here, we talk about the world of cryptocurrency, finance matters, and investments. So, please subscribe to the channel and enable alerts to be notified of each new upload. If your New Year's resolution is to begin investing for your future, but you're not sure where to begin, you've come to the right place. Investing does not have to be difficult or confusing. In fact, if you're a few decades away from retirement, investing in your future is one of the best long-term moves you can make. It can also give you a second source of income or help you get out of a financial bind. Above all, investing helps you achieve your financial objectives by growing your purchasing power over time. Perhaps you recently sold your home or received a windfall. Allowing your money to work for you is a good option. While investing can help you develop money, you must weigh the benefits against the risks. And you'll need to be in a financial position to do so, which means you'll need to keep your debt under control, have a sufficient emergency fund, and be able to ride out the market's ups and downs without having to use your funds. If you Google best ways to invest, you'll find a plethora of possibilities. But how will you know if they're worth the risk? How will you know if it's the right choice for you? Well, don't worry, since we've compiled a list of the top options available. But before you do anything else, remember that investing is a risk, so only invest what you can afford to lose. Let's get this list started. High-yield savings accounts are first on our list. If you're unfamiliar with it, it's an online savings account that pays interest on your cash balance. High-yield internet savings accounts are accessible vehicles for your money, just like a savings account earning pennies at your local bank. Online banks generally provide substantially higher interest rates due to the low overhead costs. That sounds promising, doesn't it? The good news doesn't stop there. You can get your money immediately by transferring it to your primary bank or even using an ATM. For people who will need cash in the near future, a savings account is a suitable option. So, if you're a risk-averse investor, or if you need money quickly and don't want to take the chance of losing your money, this is the solution for you. Just a reminder that the banks that provide these accounts are FDIC insured, so you don't have to worry about your money disappearing. While high-yield savings accounts are considered secure investments, if interest rates are too low, you risk losing purchasing power over time due to inflation. Let's now turn our attention to our second option, short-term certificates of deposit. Banks issue certificates of deposit, or CDs, which often pay a greater interest rate than savings accounts. When rates are expected to climb, short-term CDs may be a better alternative, allowing you to reinvest at greater rates when the CD matures. The maturity dates for these federally insured time deposits might range from a few weeks to several years. Because they are time deposits, you can only take the money out after a certain amount of time has passed. The financial institution pays you interest on a CD at set intervals. When it matures, you will receive your initial principal plus any interest that has accrued. It pays to browse around for the best deals online. CDs are a wonderful alternative for seniors who don't require quick income and can lock away their money for a while due to their safety and larger returns. This is a great option if you are a risk-averse investor who requires money at a specified period and is willing to tie up your funds in exchange for a higher rate of return than a savings account can offer. However, keep in mind that while CDs are generally safe investments, they do include reinvestment risk, which is the risk that, as we saw in 2020 and 2021, when interest rates decrease, investors earn less when they reinvest principal and interest in new CDs with lower rates. The concern is that rates may climb, but investors will be unable to benefit because their money is already wrapped into a CD. With rates predicted to rise in 2022, sticking to short-term CDs may make sense, allowing you to reinvest at higher rates in the near future. It's crucial to keep in mind that inflation and taxes could eat away at your investment's purchasing power. Hello, friend! We've made it halfway through our list, and we sincerely hope you've enjoyed it thus far. If you have, please give us a thumbs up and turn on notifications to be notified of new uploads. What do you think of the items on the list so far? Let us know your opinion in the comments below. Let's move forward with the video. We've narrowed it down to our third option, short-term government bond funds. Government bond funds are mutual funds or exchange-traded funds that invest in debt securities issued by the government of the United States and its agencies. If interest rates increase, as they are predicted to do in 2022, you won't be exposed to many risks. The funds invest in U.S. government debt and government-sponsored enterprises' mortgage-backed securities. These government bond funds are ideal for investors who are looking for a low-risk investment. These funds are also a fantastic option for new investors and those looking for a steady stream of income. If you're concerned about danger, well, funds invested in government debt instruments are among the safest investments because the bonds are backed by the U.S. government's full faith and credit. Existing bond prices fall as interest rates rise. Conversely, existing bond prices rise as interest rates fall. Long-term bonds, on the other hand, have a higher interest rate risk than short-term bonds. Rising rates will have little effect on short-term bond funds, which will gradually increase their interest rate as rates climb. If inflation is strong, though, the interest rate may not be able to keep up, and you will lose purchasing power. The Series 1 bonds could be your fourth option. Individual investors can buy savings bonds from the U.S. Treasury, and the Series 1 bond is a good option for 2022. This bond aids in the creation of inflation protection. It pays a base interest rate and then adds an inflation-adjusted component. As a result, as inflation rises, the dividend grows as well. The opposite is also true. As inflation falls, so does the interest rate. Every 6 months, the inflation adjustment is reset. If not redeemed for cash, Series 1 bonds earn interest for 30 years. Series 1 bonds, like other government-issued debt, appeal to risk-averse investors who do not want to risk default. These bonds are also a smart choice for investors looking to protect their money from inflation. However, investors are limited to purchasing $10,000 in a calendar year, though you can use up to $5,000 of your annual tax refund to acquire Series 1 bonds as well. The Series 1 bond protects your money from inflation, which is a major disadvantage of most other bonds out there. These bonds, like all government-issued debt, are regarded as among the safest in the world in terms of default risk. And if you haven't found the ideal option yet, then short-term corporate bond funds are the way to go. Corporations may raise capital by issuing bonds to investors, which can then be pooled into bond funds that own bonds issued by dozens of different companies. The average maturity of short-term bonds is 1 to 5 years, making them less subject to interest rate swings than intermediate or long-term bonds. Investors searching for cash flow, such as retirees, or those who wish to minimize their overall portfolio risk while still earning a return, can consider corporate bond funds. Short-term corporate bond funds, like other bond funds, are not insured by the Federal Deposit Insurance Corporation, or FDIC. Investors in investment-grade short-term bond funds often earn larger returns than those in government and municipal bond funds. However, greater profits come with a higher level of risk. There's always the possibility that a company's credit rating will be reduced, or that it could run into financial difficulties and fail on its obligations. Make sure your fund is made up of high-quality corporate bonds to mitigate this risk. Which one do you think is the best? That concludes today's video. Please subscribe to the channel and enable alerts to be notified of new uploads. This is Financial and Investment Wisdom, and we'll see you in our next video.